Thank you so much for joining us. I am Amy Raskin, the Chief Investment Officer of Chevy Chase Trust. As we wrote about in our most recent quarterly letter, despite the relatively steady 8-year equity rally, the complacency and euphoria that typically surround bull markets just doesn't seem present today. Investors disproportionately select asset classes that they believe have no principal risk, even if the returns are subpar. After accounting for inflows and outflows during this 8-year bull market, U.S. investors have pulled $462 billion out of equity markets. U.S. investors have, however, invested $1.7 trillion in bond funds. Due in part to regret aversion, we don't expect this dramatic reallocation of assets to change anytime soon. Well, we're not psychologists, but our best guess is that this is likely due to the byproduct of our recent history. Within the space of a relatively short time period, let me see if I can get this right here, we've had two severe equity market meltdowns in both duration and magnitude. This chart, we've highlighted all of the bear markets going back to the Great Depression in 1929. As you can see, there were only 5 years, right here, between the bear markets in the first decade of this century. This short of a time period between bear markets had not occurred since the 1970s. And since most of us did not have a lot of money to invest in the early 70s, for many that period is not top of mind. In contrast, the 1980s and the 1990s were exceptionally fruitful decades for equity investors. Almost 26 straight years of bull markets. Everyone thought they were stock market geniuses, and you had to really work hard to lose money in equities. We think the scars from the back-to-back declines beginning in 2000 and then again in 2008 are still having an influence on investor behavior today. While being overly risk-averse is a behavioral tendency we try to guard against, we also recognize that risk management is a critical component of our job, and we want all of our clients to be able to sleep at night. And frankly, we want to be able to sleep at night as well. So in other words, we don't want to take excessive or undue risk. So over a long period of time, we have developed a robust 4-step investment process that we believe helps us identify and capitalize on investment opportunities earlier than our competitors. Importantly, it also helps us manage risk through both proper identification of where we are in the economic cycle and very careful and deliberate portfolio construction. The first step of our process is identifying and researching our investment themes. This is our starting point. It makes our investment process unique. There are thousands of public securities available for purchase in the world. Every investment manager needs a process to whittle down the investment universe into a manageable group of companies. Many firms use a quantitative screen. For example, they will look for stocks that trade below a certain price-to-book or price-to-earnings ratio. Others will limit their overall mandate from the get-go. They will label themselves U.S. large-cap growth managers or small-cap emerging market value managers. We use our themes to guide where we hunt for investment opportunities. This is really the heart and soul of our firm. Spencer will talk about this in greater detail in a moment, so I will quickly review steps 2 through 4 and then turn the podium over to him. The second step in our process is our assessment of the global macroeconomic landscape. This helps us determine the weightings of each of our investment themes. Every week, we go through all of the economic data points that were released over the past 7 days. This helps us stay focused on the facts and minimizes another dangerous behavioral tendency called confirmation bias. Confirmation bias is a tendency for people to seek out information that confirms their existing opinions and overlook or ignore information that refutes their beliefs. Confirmation bias occurs when people filter out potentially useful facts and opinions that don't coincide with their preconceived notions. By examining every data point and focusing in particular on the data that contradict our working framework, we are constantly challenging our assumptions and asking ourselves where we can be wrong. These meetings are absolutely essential in identifying turning points in the macroeconomic backdrop. You've probably heard the adage, you can't time the market. And of course, if you're trying to pinpoint precise dates and times, that is true. Nonetheless, understanding where we are in the economic cycle should be a critical input in every investment process. Our work led us to increase our geographical diversification towards the end of last year and has helped us effectively shift between value tilts and growth tilts at appropriate times during the past few years. These somewhat subtle but impactful repositionings significantly contributed to our recent performance. We didn't exit or enter any new themes. We just reweighted our holdings to incorporate a slightly different economic viewpoint. The following chart makes it clear that successful investing requires more than simply analyzing corporate earnings. Market multiples vary dependent on the economic landscape. The orange portion right here of these bars show the impact changes in the market price to earnings ratio have had on overall returns. As you can see recently, changes in PE ratios have had a greater impact on returns than the contribution from earnings growth. Market multiples tend to rise when inflation is falling. They tend to decline when inflation is rising. Bear markets are almost always associated with recessions, and recessions are almost always predated by a rise in inflation, higher levels of unemployment, widening risk spreads, and a plateau or decline in corporate earnings. None of those conditions exist today. Somewhat counterintuitively, what's good for Main Street isn't always good for Wall Street. Slow economic growth keeps inflation and interest rates low. This is actually a good environment for equities. A pickup in growth, particularly at a time when there isn't much slack in the economy, as measured by the unemployment rate at 4.2%, could herald in inflation and therefore the end of the bull market. We are vigilantly watching for signs that a sustained pickup in inflation might be brewing. And now just a quick note on valuation, because we get this question a lot. Equity market valuations are high. There's no doubt about it. Currently, the price to earnings multiple of the S&P 500 index is about 21 times. On average, on average, investors are paying 21 times earnings for companies in which they are investing. The average PE ratio since 1950 is about 16 times, so we are notably higher. Inflation is also notably lower than the average inflation rate over the past 70 years. Inflation today stands around 1.7%, whereas the average is about 3.5%. Some people would make the argument that compared to interest rates and accounting for current levels of inflation, equity markets are cheap. Now, I'm not going to make that argument, but I am going to tell you that the relationship between valuation and next 12-month price performance of equities is just about zero. Expensive markets can, and more often than not, do get more expensive. Therefore, it's much more important to focus on the changes in the macroeconomic backdrop that will influence that PE ratio more than fret about current valuations. And we can talk about more of that in more detail in Q&A if you're interested. But the third step in our process is individual company analysis. The biggest issue I see with portfolios that are transferred into Chevy Chase Trust is over-diversification. Clients often transfer in portfolios with dozens of exchange-traded funds containing 50 or 60 securities each. In some cases, they have more stocks in their portfolios than there are in the S&P 500 index. Often in these instances, they are paying layers and layers of fees for portfolios that structurally have almost no chance of outperforming, because they are just not sufficiently differentiated from the index. We've written a few white papers on a concept called active share. You can find those on our website. But the gist of the analysis is that you have to be different in order to achieve a different and hopefully superior investment results. Our portfolio typically consists of no more than 45 individual equity securities. This allows us to be sufficiently diversified from a risk management perspective, but enables us to outperform on a relative basis. Between 2/3 and 3/4 of the companies in our portfolios are direct beneficiaries of one or more of our investment themes. Stocks that have exposure to more than one theme typically have higher weightings in portfolios. Each security is covered by a Chevy Chase Trust research analyst. Bobby and Tap will provide specific examples of how our thematic research translates directly into stock selection. And this brings us to the final step of our investment process, which is risk management and portfolio construction. Again, let me reiterate, we want you to sleep well at night knowing that Chevy Chase Trust is managing your assets prudently. We employ some of the most successful and powerful quantitative tools to flag potential systematic and company-specific risks in client portfolios. These tools examine dozens of metrics such as earnings revisions and variation, free cash flow production, changes in accrued earnings and shares outstanding, short positioning valuation metrics, and hedge fund and ETF ownership, just to name a few. If a quantitative model is indicating that a fight is breaking out in one of our holdings, meaning that there may be a growing short interest as the share price is climbing, or the range of analyst estimates for future earnings is widening more than usual, we conduct a thorough review of our long-term investment thesis and the company's competitive positioning. If something has changed, we will likely take action by altering the position size or potentially exiting the security altogether. In addition to quantitative tools, portfolio construction is an extremely important part of our risk management process. We're fortunate as long-only investment managers. Our upside potential in each holding is unlimited, but our downside risk is limited to the amount of the position. In other words, if you have a 1% position in a company that we think can triple, the upside potential is 200 basis points, but the downside risk, if it goes to zero, is only 100 basis points. Now, this is an overly simplistic example, but for short sellers and hedge funds, the math works the other way. For example, if you had a 1% short position in NVIDIA in 2014 and didn't cover, that relatively small 1% position would have reduced overall portfolio performance by 800 basis points, or 8%. We use this asymmetry to appropriately size positions within client portfolios. Our most speculative companies, the companies that we believe may offer the greatest reward but also have downside risk, tend to have relatively lower weightings. We at Chevy Chase Trust spend a good deal of time conducting research that others may deem to not be directly relevant to specific security selection. You'll see examples of this today. However, we are confident that this research gives us a unique perspective and makes us better investors.